Okay, for chapter 9, we have just introduced the different learning objectives. The first, long-lived eyesights. Okay, long-lived eyesights. So one category is property, plant, and equipment. So that would including land, building, machineries, vehicles, computers, right? You name it, all those type of long-lived eyesights, right? You can use it for, multiple years at least period of time. So we want to know what is the initial cost, right? That's the time when those eyesights were first required, right? First acquired, how much you want to record it, right? That's the cost. And then in the subsequent years, each year you have to recognize the cost for using the eyesight, which we call it depreciation, right? And what is the depreciation? And then when factors changed, right, you need to revise the depreciation. And then, when you don't use the eyesight, you want to dispose it. How do you deal with the disposal? And then for the natural resources, we're going to focus on the cost depletion, right? Depletion is kind of the counterpart for depreciation, okay? And the intangible asset and goodwills. So we're going to learn about how we're going to make the accounting journal entries for the intangible asset. Some of the asset have limited number of years of useful life. Others, they have indefinite number of years of useful life, okay? So the accounting will be different for different assets. So PPE, okay, PPE, so they have physical substance, right? You can describe it in terms of the size or the shape, right? So you use them for production or supply of goods or services, for rental to others, or for admin purposes, okay? So, so for example, you have a building, right? You have a building, which is a PPE, right? So you can rent the building out, right? You can rent the building out to other people, third parties. So you earn rental income, okay? So that's the time you can use the PPE for rental purpose, right? It can also for admin purpose. For example, let's say the headquarters of a big oil company, right? So the headquarters building of an oil company, right? The people working in that building, they are admin people, right? They are probably executives. They are maybe accountants. They are not the frontline workers, right? The frontline workers, they are working in the north, right? In the north of Alberta. So in this case, that building will be for administrative purpose, right? It could be used for production, right? So let's say in the building, okay, maybe people will use the building for holding badminton class, volleyball class, dancing class, right? So in that case, that building created a space for this service activities, to occur, right? So in this case, these buildings will directly earn the income, right? The service income, okay? And we are expecting that the building can be used for many years, right? You don't have to sell the building right away. The building is built pretty strong, it will not collapse after 1 year, right? So you can use it for a number of years, many years. Okay, so there are 4 classes of the PPE. You have land, okay? We all know what land is. And land improvement. So land improvement would be like you build a fence, right, on the land. You paved a driveway on the land, right? You paved a sidewalk, right? So those will be the land improvement, okay? Landscaping, right? Those will be the land improvement. Well, the difference is land does not depreciate. So in Vancouver, land does not lose its value, right? Actually, you know about what is the real estate market in Vancouver. Land's value appreciate all the time. So you do not depreciate land, okay? But land improvement can depreciate, right? You build a fence, and the fence will get old, right? Because of the rain, the snow, and eventually the wood will be rotten, right? And then the fence may fall, may collapse. You have to rebuild it, right? So land improvement can be subject to a depreciation. And the buildings, right? You recognize depreciations on building. So equipment, right? Like computers, equipment, right? So those will be the 4 classes: land, land improvement, buildings, and equipment. Determining the cost. So what does this cost including, right? So if you say, on my financial statement, okay, this this building, this land is $2 million, right? So how did you get that number, the $2 million? What cost can be included in the calculation of the cost? So purchase price, right? You buy it from a seller. So that purchase price is definitely part of your cost. Non-refundable taxes, right? So that's the portion of the tax you paid to the government, you cannot get it back. So non-refundable. So that's your cost. And sometimes you may get a discount or rebate. So that's the money you received, right? So those parts should be considered as a reduction in the cost, okay? So purchase price, non-refundable taxes has to less any discount or rebates. And all costs necessary to bring the eyesight to location and make it ready for use, okay? So this is very interesting. So think about university, right? They have equipment, right? So like a projector, we use that equipment for the classroom, right? So now we think about, right? When the university record these projectors, right? So what cost they are going to record, right? Well, for sure, they paid for, right? So you include that purchase price. So you go to Best Buy, right? You found that projector there, okay? So you have to pay the projector, right? But you will not leave it in Best Buy because you and we are not going to Best Buy, right? To have a classroom to learn there, right? So you have to bring that projector to the building, the classroom, and so there is additional cost, right? Maybe there is a shipping cost, right? So that cost should be included as part of cost of projector, the eyesight, okay? But you don't leave that projector on the podium, okay? Because that's not how projector should be used, right? So you have to install it, mount it to the top of the roof, right? To the ceiling, okay? At the right location, right? In order to realize the benefit of it. So you can see that now there's additional mounting installation cost. So all this cost, the price plus the shipping cost plus installation cost. Okay, this cost will be all included together. That's the cost of your projector. Okay, equipment you need to recognize on the balance sheet as your property, plant, and equipment. Okay, so it's not just simply the purchasing price. That's just part of it. Okay. And the third one is the obligation to remove, restore assets when it is retired. Okay. So sometimes not only you consider the cost you pay already, sometimes you have to consider the future cost. Okay. So these cash flows you already incurred, you paid, you include those, right, as cost. But for some other assets, you have to consider the future effect. So for example, if you have a convenience store, right? You have a convenience store, you would have a building, and you probably have a gas station, right? Now the problem is running a gas station, you are subject to the risk of the soil contamination, right? So there are the environmental laws, right? So when they allowed you to build this convenience store with a gas station, if you stop using it, you change the purpose of the property, the land. According to environmental law, you are liable to clean up the site, right? Because you use it for many years, there are potential soil contaminations, right? That it's bad to the environment, probably bad to people's health. And now you are going to build a residential building on the piece of the parcel of the land. So there are environmental laws in Canada. We will ask the people who sell the land, they are responsible to deal with the land. So when you record the gas station, that asset, right, the building, not only how much it costs you upfront, you also have to consider when I terminate the operation, okay, how much it's going to cost me to clean up the site, right? So you have to estimate how much money I have to pay in 35 years when I'm going to terminate the operation, okay? And then what is that cost in today's dollar, right? So you have to include that cost. But there's the terminology for that. It's called eyesight retirement cost. Okay, so you can see that it's not that when you recognize the cost of long-lived eyesight on the financial statement, so that number, cost number, is not that simple. It's not just the purchase price. There's also different factors to consider. Okay, so we say this cost are capital expenditures, they benefit the future periods. The cost benefit only the current period. We call it operating expenditures. Okay? So expenditures is different from expenses. Okay? So English is my second language, but now I have to explain the differences between the two English words. So expenditure and expenses are different. Expenditure is the cash outflow. Okay, so expenditure is about cash flow. It's the cash leaving your pocket. So you are spending cash. That's called expenditure. Expenses is the item on your income statement. You have revenue minus expenses equals net income. Okay. So expenditure is about cash outflow. Expenses is the items on the income statement. So when you spend money, the capital expenditure, those cash outflow has longer and the future benefit. But the operating expenditures only have benefit for the current period of time. So that's the difference. So one example would be if I replace the roof, okay? I spend $100,000 to replace the roof, right, of a building. So this expenditure will have benefit for many years, right? Because I don't replace roof every year. I replace it every 5-10 years, right? So that roof will be a capital expenditure. But if you, let's say, if you every year, if you you repaint the logo outside the building, right? So University West Canada, you have a pretty logo outside the building. Well, every year you want to use fresh color to repaint it, right? So then that benefit only for 1 year, right? So you paint it, it lasts for 1 year, right? The color became fainted, and then you repaint it, right? So in those cases, those are the operating expenditures. What about land? So cost of land will including a purchase price, how much you pay for it. And also it has legal fees and survey fees, right? So when you purchase a land, you are most likely to do this through a lawyer. So don't do this, just have a private deal, right? There are a lot of potential issues can go wrong, right? Lots of hidden liabilities, right? Things could go wrong. So you need to hire a lawyer. So you have to pay the lawyer. So there are legal fees, right? And then sometimes the land is not ready for use. You have to prepare it. For example, you purchase a land, there are a lot of trees on it, right? And your goal is to, build something on the land. So the land is not ready to use. So what are you gonna do? You have to hire somebody to chop down all the trees, right? Which is very sad, right? If you are environmentalist, so you have to chop down all the trees, right? Dig out the trunk, and level the land, so make it ready for construction. So those are costing you money, right? So you buy a raw land, right? You pay the lawyer fee, but that's not all, right? If the land is not ready, you have to spend extra money to make it ready. So those will be all the cost of the land. Land improvement. So let's say you have a driveway, right? Sidewalk, fences, parking lot, landscaping. This would be all considered as the improvement, right? You are adding these structures to the land to make the land better accessible, right? To make it prettier landscaping, right? So for land improvement, it has limited useful life, right? So the fences can fall and rotten. The driveways, sidewalks, they are concrete, but over the time, the soil will sink down, and then what happened is your the cement will be cracked, right? So you have to patch it, replace it, right? Just like the road, right? Over the time, you first build a smooth, flat road, right? Over the time, that road condition will deteriorate, right? It will be holes in it. It will be lots of cracks. So you have to fix it, right? To patch it, to rebuild it, right? So those would be the signs of deteriorations, and you need to recognize this depreciation, right? The value declines over the time. And the buildings. So you could purchase a building, or you could construct a new building. If you purchase a building, well, you pay the purchase price, you pay the legal fee, and you need to get the building ready for use, such as remodeling and repair, right? So for example, if you buy a building, that building was used to be a retailing building, right? So basically, they use the building open space and they sell clothing. It's a retailer, right? Lots of open space. Customer came, they buy clothes there. But now you bought the building, but your intended use is to make this building to be office building, right? So it's all open space. Now you have to remodeling the whole space, right? Build some drywalls, right? So you have some office rooms, right? You may have a boiler room, you may have a kitchen area, you may have a receptionist desk, right? A waiting zone, right, for office building. So because you have a different purpose, now you have to remodel that building space to make it suitable for your business intention, right? And this is all going to cost money, right? And this money will be part of the cost that you recognize as part of the building. Let's say if you construct your own building, okay? You construct your own building. So then, so basically, you are going to get a bid, right? There are different constructors. So you need to get a bid from them. So they will give you like a contract price, how much money they're gonna charge you. And you probably need to hire architecture, right? Architect to design your building. And the government has to approve your building. So you need to get a building permit from the government. And if you don't have enough money during the construction, you probably need to borrow money from the bank and you have to pay interest. So those costs are all considered as buildings, okay? You can record all these costs as buildings. Equipment, okay, equipment. So there are different categories of equipment. So you have delivery equipment, office equipment, computers, machineries, vehicles, furniture, and fixtures. Right? Those are the broader category of equipment. So the cost of those equipment should include purchase price, right? How much you paid for it. And often case, let's say furnitures, some equipment, they are too big. You can't just stock it into your own car, right? So you pay delivery fee. The company will deliver it to your building. Okay, so if it's really expensive machine, you don't want anything went wrong when they are on the go, right? So you have to have an insurance, right? You have to have an insurance. And if it's a piano, for example, right, you have to test it to make sure it sounds correct, sounds right, right? So the idea is to bring this equipment to get to them ready to be used. You need to pay for the price. You need to have it shipped to your location. If your items is very expensive, hard to replace, you probably need to have an insurance on it. Okay, once it's arrived, you probably need to assemble it, right? Install it, and then testing on it. So those would be all costing human labors. Those all cost money. So those costs will be all part of the equipment. Okay, so now I'm going to stop here.